What if the United States responds to its enormous debt burden with an old strategy, allowing inflation to reduce the debt's real value over time? That approach would not be entirely new. In the 1960s and 1970s, inflation weakened the purchasing power of the dollar and reduced the real burden of dollar-denominated debts. But the consequences were painful. Interest rates climbed, confidence in the currency weakened, and stocks struggled to keep pace with inflation. For much of the 1970s, the stock market struggled to keep pace with inflation. Investors had relatively few ways to protect themselves. Gold was one of the clearest monetary hedges. It rose dramatically. Stocks, meanwhile, could gain in nominal terms while delivering disappointing returns after inflation. Now consider the same basic pressure in a very different financial world. Today, investors can access assets that did not exist in the 1970s: stablecoins, cryptocurrencies, and Bitcoin. These technologies may change how people respond to a weakening dollar, and how the dollar itself moves through the global economy. Start with stablecoins. A dollar-backed stablecoin is designed to maintain a value close to $1. If these digital dollars become widely used for payments, savings, and international trade, they could expand the dollar's reach rather than weaken it. There is another important connection. Many stablecoins are backed, at least in part, by cash and short-term US government debt, such as Treasury bills. If demand for stablecoins grows, their issuers may need to hold more of those reserves. That could create additional demand for short-term treasuries and help reinforce the dollar's role as the world's main transactional currency. But here's the paradox. Stablecoins could strengthen the dollar as a payment network while increasing demand for assets designed to protect against declining purchasing power. Bitcoin offers one possible destination. Its supply is digitally limited, and its rules are not based on the decisions of a central bank. Gold offers another. It remains the traditional monetary hedge, with a long history of preserving value when confidence in currencies is under pressure. Productive assets, including stocks, may also respond differently than they did in the 1970s. Companies can raise prices, grow revenues, and adapt to changing conditions. So the result may not be a decade in which the stock market simply moves sideways. A more subtle outcome is possible. The stock market could rise substantially in nominal dollar terms, and still underperform gold, Bitcoin, or other scarce assets in real purchasing power terms. In plain language, your portfolio might make money while making you poorer relative to assets that hold their value more effectively. That does not mean Bitcoin must rise, gold must outperform, or stocks must fail. Each asset carries different risks. Stablecoins depend on their reserves, their issuers, and the rules governing them. Bitcoin remains volatile. Gold can spend long periods moving little, and inflation itself is never perfectly controlled. The larger question is not simply whether the dollar disappears. It is whether a new monetary system is taking shape, one where each asset plays a different role. The dollar may remain the dominant unit for transactions, while stablecoins become its digital distribution network. Gold and Bitcoin may serve as scarce monetary hedges, while productive assets offer exposure to economic growth. If that is where the world is heading, the most important decision may not be predicting whether the stock market rises or falls. It may be understanding which role each asset is designed to play, and how those roles interact when money itself is changing.